Thank you so much for your time and interest. As you know, my name's Ken Fisher, and I'm speaking to you from Camas, Washington in America. And I'm so delighted to be able to do this. I'm even more delighted after a bit to be able to answer your questions. I'm going to try to keep my comments on the briefer side, so that works well. I want to point out some things that I think are unusual about this market that are not commonly talked about in the way that I would talk about them. First, if you look at the market this year, and people do know this, the non-US world, as represented by the MSCI World Index, has done a little bit worse than the S&P 500's done, and is now almost back to its all-time highs before the bear market. But the technology world, led by mega cap tech, has done spectacularly well, both in the downturn, going down less and coming back more. And it's now at all-time highs. If we look just simply, however, at the correction itself, or the bear market itself, which it's kind of a confusing thing in that the bear market was a little bit bigger in magnitude than the average bear market of modern history, but so much shorter. Shorter almost exactly like a normal correction, but like so much bigger. It's like a mega correction, and in so many ways it's acted like a mega correction. And in that, one of them is that the things that were leading the market before it occurred have continued to lead the market during and after. And that doesn't happen in a conventional bear market. In a conventional bear market, the bottom of the bear market is shifting, where typically small stocks and value stocks, which in a lot of ways is what the Indian market is, take over and lead harder. And that hasn't happened in this period. Big, mega, high-quality growth has continued to lead, as evidenced most particularly and spectacularly by mega cap tech, and smaller and value have struggled. And in fact, that's what you see when you think of the so-called breadth of the market, which is how many stocks are leading the market higher in the bull market. Through the course of the very short but big downturn, breadth has continued to narrow as fewer and fewer stocks have led the market higher. What this means is that the market's acted more than anyone would think like it was a correction and not a bear market, even though technically it was a bear market by its magnitude. That further, the types of stocks that were leading continue leading, which makes it act like an aging bull market, not like a new bull market, even though technically it is one. Now, I want to shift gears and talk about politics in America, because the American market, as you know, the US market, is the biggest single market in the world, and the rest of the world correlates very highly with the US market. If you go back to that visual that I showed you, the correlation between the US market and the non-US market is, in total, is almost 100%. And when things correlate, most all the time, for a long time, there's a reason for it, and that's because those markets compete against each other for all the basics. When we think about the world, we can say some things that people don't get, which is that there's some impacts of American politics that impact the US market, and from that the non-US market, that I don't think a lot of people really think through very correctly. So first, in this visual that you can see, we have the entire history of the S&P 500 in America laid out by the first year of a president's term, second year, third year, and fourth year. And as you know, in America, unlike most of the world, there's a definitive four-year term for president. Sometimes they get a second one, sometimes they don't. In days of old, when Franklin Roosevelt, on this visual depicted as FDR, was president, you could have more than two terms. Nowadays you can't. Sometimes presidents have died in term. That would be John Kennedy and Franklin Roosevelt himself. But the reality is, in this visual, negative years are in red, positive years are in black, and you can see that almost all of the negatives, not all, but almost all the negatives, are in the first or second year of president's terms. The back half has much less risk. There are some negatives there. There are some bigger negatives, but most of those negatives still, again, 2/3 of them are way back in the time period when Franklin Roosevelt was president, not in more recent times. And an awful lot of those years that are positive, when they're not negative, those positives are pretty often big. Now, the fourth year is mostly positive. It's positive on average about 11% and about 83% of history. That's pretty big numbers. Moreover, they depict in this unusual way from this visual. And what this visual shows you is that fourth year again, and the inaugural years arrayed in this way. What happens when a Republican, it's the same data, what happens when a Republican wins in the election versus what happens when a Democrat wins in the election, and then what happens in the inaugural years for the Republican and for the Democrat. And what you see when you put those data together in the way I just depicted is that election years, when Democrats win, have on average been slightly negative. When Republicans win, they've been nicely positive. On the other hand, in the inaugural year, those two flip-flop. Democrats have big inaugural years. Only one Democrat since World War II hasn't had a double-digit positive return, and that was Jimmy Carter in 1979. He was only down 7.9%. It wasn't a big negative. On the other hand, just as Democrats don't have big election years in a positive sense, neither do Republicans in inaugural years. Republican inaugural years are small. The two put together aren't very different. They're not different enough to matter statistically. You can see that on the right in this visual, where the one is 13.1, the other is 15.9. For the 2 years as a whole, it doesn't much matter who wins. But what does matter terribly is the timing of it. So if in fact this year is to be a better year, it's probably true that President Trump wins. If next year, 2021, is to be a better year, it's probably true that former Vice President Biden wins. This is not about partisan politics or who you like or who you dislike. And the reason this works is because the Republican is typically thought of, not necessarily is, but is typically thought of as more pro-business, more anti-regulatory, more pro-market, more free market. The Democrats typically thought of as more regulatory, more growth of government, more anti-business. And so those fears when the Democrat gets elected tend to hold the market down in an election year. The American system, despite everyone's biases to believe everything that they ever thought in recent years about everything about politics and not believe anything that contradicts it, the fact is that newly elected presidents, whether Republican or Democrat, don't get to do nearly as much as what they promised and talked about when they were running for office. So to the extent that Democrats frightened the market a little or Republicans made them hopeful in the election year, when they actually win with the Republican, there's a disappointment. With the Democrat, there's, oh, it wasn't so bad. And you should expect that with Biden in particular if he wins. I don't know who will win. We'll talk about that a little. But if Biden wins, he won't be able to do that much. If Trump wins, you know what? He won't be able to do that much. It works the same way. We're going to have a very divided Congress in America, no matter what happens. And so this pattern that you see here should prevail in this period ahead. Now, if you take all those 4 years that I had there in that visual to back, this one, the 4th year is the election year. If you take all of those and you array them by weekly returns throughout the course of the year, it looks basically like this, where the first half of the year is basically wiggling around, going nowhere fast. And the back half of the year goes up nicely. If you think about it, and people don't, despite the bear market that, as I told you earlier, acted more like an oversized correction than a bear market in terms of its speed and what led before and after, the fact of the matter is, to where we are now, the market is almost exactly where you would expect it to be if it were a perfectly average election year. Now, in this case, unlike in the prior one where you see the upward slant, you don't get so much upward slant because to not make the black line go way off the page, we had to flatten the percentages on the yellowish brown line a little bit, just simply to be able to fit it onto the page, although the percentages are the actual same, even though they don't look like they are. So my point being that you should expect to see acceleration in the back half of the year. Why is that? The reason that that works for America and then that bleeds over to the rest of the world is because simply early in the election year, there's so much uncertainty. And a basic principle of markets that I can't overemphasize this is the absolute level of uncertainty is always unimportant to markets. What's important is markets love falling uncertainty and they hate rising uncertainty. And in the early portion of a presidential election year, all the aspiring candidates make a lot of extreme promises. And in making the extreme promises, they end up creating uncertainty since you don't know what will happen. You could see that this year with all of the many candidates on the Democratic side seeking the nomination and making all kinds of crazy promises. Finally, you get two candidates, things begin to clarify, vice president gets picked, a vice presidential aspirant gets picked, platforms get built, and uncertainty falls as you get a more certain race. Markets are good at pre-pricing, and the market in the back half of this year will figure out the winner before we do. And in doing that, it will price it consistent with what I said before, but you tend to get rising. And why do you tend to get rising? Because it's a period of falling uncertainty in America for a very important thing that bleeds over to the non-US world. Now, let me say a couple of simple lessons. And the fact of the simple lessons is that polling doesn't matter. This is the way the presidential election would come out based on the American Electoral College, which is the thing that really determines the presidency. If the states voted for president the way they have in 4 or more of the last 5 elections, this actually would tell you that the odds of the Democrat, Mr. Biden, winning are overwhelming. There's a pretty good chance that's true, pretty good chance it's false. Sometimes this works. More of the time than not, this works, which is what you would look at it instead as a bottom-up modality. And here, this is if the states vote with the party of their state legislature. Again, Republican states in red, Democrat states in blue. That was equally true for the prior one that I showed you. But with both of these, if the states vote as their legislatures vote, which is what happened in 2016 when President Trump won 306 electoral college votes, then President Trump would get reelected. And the fact is, the bottom-up modality has predicted basically 6 of the last 10 presidential elections, the top-down only 4. So my bias is I don't know who's going to win, but here's what I know. We're going to get a winner. And when we get a winner, the market likes it better than they think they will. The Senate is going to be very close because if you take the Senate seats as shown here, which is already very close, the Republican senators running for re-election in red, Democrats in blue again, and you split the line on where a 50-50 vote was for Trump as a Republican or Romney as a Republican the last 2 times, and it would work exactly the same if instead you looked at the race against Senator Clinton or Secretary of State Clinton and former President Obama. The numbers would come out identical, just exactly flipped. There is not that much opportunity for either party to take a lot of seats. This is going to end up being a Senate that looks a lot like the Senate we have now. The House is hugely impacted by the Senate races. So it's going to be a very split Congress, and the next president will not get much through. And this leads me to the point that I want you to see. When the government can't do much one way or the other, also called gridlock, markets love it. I expect that's what we'll see in 2021, and I expect we'll get that pre-priced in 2020, and I expect the market will be pretty good. So I've been talking for a long time in terms of the time that's available for me before I get to Q&A. And I want to leave you with one last point. Markets pre-price widely available information. And that's sort of their day job. And their night job is a little different. Their night job is to value all of the future earnings stream at what would appear to be a reasonable interest rate. That's a formal theoretical concept which we've known for a long time. It's wanting to do both of those at the same time, but it struggles between the two. There's some tension there. Sometimes, the market's almost always pricing the next 3 to about 30 months. This is a basic lesson I want you to learn. It rarely prices shorter than that, and if it does, never for very long. And it never prices for longer than that. If you tell me about something that you know that is certainly going to happen in 10 years, I'm going to tell you the market's not going to really price it for a long time. People might talk about it, but the market won't price it. Whenever we've had a period of a big bear market, the bottom is being formed as the market has figured out, in a pre-pricing sense, about when and about how bad the rest of the recession after that will be. And the economy keeps deteriorating while the market starts going up. While it's going down in the steep plunge at the back of a bear market, and the back of a bear market's always a steep plunge, what it's doing is pre-pricing the very short term of that 3 to 30 months. Once it does that for just a little while, it flip-flops off to price the long term. And as it's pricing that long term, it's also valuing all the future earnings stream. And so what I'm going to tell you is this year, after a very short period of pricing sheer panic and an economy that would deteriorate and destroy earnings domestically in your country and everywhere else, it shifted to start thinking about what the world would look like in 2022, 2023, out at the 30-month range, and said, this is all going to be over. That's why it's acted the way it's acted. It's going to keep that, but it's going to slowly start moving back sometime toward the middle of that 3 to 30 months. And this bull market, which has begun in an almost perfect V-shape to the downturn of the bear market, will, as normally happens, start to accelerate more slowly. And with that, I've used up my time. I'd be delighted to answer any questions you have. Thank you very much for your interest, and I hope you found today somewhat educational. I only had a limited amount of time, so I only had a limited amount of time to talk about various things, so I tried to keep it tight, tried to keep it limited, but I'm open to any kind of question about anything I talked about or did not. Again, thank you very much.
Thank you for that wonderful presentation, Ken. And I have a whole lot of questions for you.
Thank you for having me. It's an honor.
And I like and appreciate the fact that you say as it is, you don't mince your words. You have very little this thing for politeness, unnecessary politeness. Am I correct?
I don't know. I'm not sure that I even always know what politeness is in different circumstances.
Oh, fantastic. Okay. Again, over the last 5 months, the markets seem to be having a life of their own. They seem to be somewhat disconnected with the fact that the world is going through a pandemic. Economies have shut down. Economies are in slowdown. But the markets, both the US and the Indian markets, are both doing well. Indian markets have certainly surged ahead of what they were 5 months back. They've surged ahead of what they were a year back. So what exactly is going on, Ken? What do you make of it?
So as I said in the presentation, the downturn is, as we all know, forced by the government's shutting down commerce in the name of fighting coronavirus. And that led to immediate panic. The market is always, and this is the part that investors ought to know that mostly they don't, the market's always pre-pricing. Sometimes it's pre-pricing close to 3 months into the future. Sometimes it's pre-pricing out maybe 30 months into the future. And figuring out where the market will go is heavily about, is it pre-pricing on the short end of that time frame or on the long end? Whenever you get to panic, which is what we had in February, March, the fastest bear market decline in history off an all-time high. Whenever you get that, once you hit the panic stage, the market's pre-pricing the very short end of that time frame, and it very quickly moves to price the very long end of that time frame, which it did starting March 23rd. Once it does that, it's pricing out 2022, 23, and by then coronavirus and all this other stuff is old news. The market in the short term, as Warren Buffett always said, is a voting machine, meaning sentiment. In the long term, it's a weighing machine, meaning value, and that value is the present value of all future earnings. And what's going on with earnings right now only impacts that a little bit, so the market looks right past it. It does that after every bear market. Once you hit the panic stage, it moves to think about the long term. And those who think the market is disconnected miss that they're disconnected from the way markets actually work and have always worked. There's nothing unusual about the way the market's working now. The only thing that's unusual is that governments around the world shut down all business and then have opened up.
But what should retail investors, the small investors, do in such situations? The classic textbook advice is, relook at your asset allocation. But when the markets are moving so fast and so sharply, is there really a need to do this? And I go about doing rebalancing my portfolio, and hey, 2 months later, I'm proven wrong. Markets are back to where this thing and all this actually just caused a lot of trading and stuff in my portfolio. That's it.
So, what finance theory would say that is correct on this topic is to make profitable trades, you have to know something other people don't know, because the market's a pre-pricer of all widely known information. And the fact of the matter is, the normal retail investor doesn't know something other people don't know, may, but probably doesn't. And everybody, normal retail investor, professional, everybody ought to be asking themselves all the time, what do I know other people don't know? And that would either be, I know something about how markets work other people don't know, or I know something about the circumstances. But if you're making decisions based off the same things everybody else is making decisions on, that's all been pre-priced. And there's no ability to make an extra profitable margin out of that. And so you ought to be passive. Plan in that circumstance your long-term needs, set asset allocation for that, and don't let yourself be influenced by, if you will, the news.
Okay. Ken, another thing, you observe so many different markets. You look at global markets, and I'm sure you would have been watching the Indian market, if not investing in it very closely. One belief that we've held here in Indians, that our economy is growing faster, our markets have done well over the last few years, and hence investing in Indian markets for us is much better off than investing overseas. Given the fact that you have decades of experience, you've seen cycles, you've seen all markets, what is your advice to Indian investors?
So basically, I disagree with that view fundamentally. How a stock market does in the long term is overwhelmed by the ability of investment banking capability to work with companies to create new supply of equity. And the price of equities is determined in the long term by shifts in supply and demand for equities. And so once a category is envisioned by lots of people as superior, investment bankers and companies will try to take advantage of that by creating new supply until they've overwhelmed that demand. Fundamentally, when you look at long-term history, major categories of equities have very, very similar very long-term returns. When you look at the Indian market very specifically, the fact is it is a small cap value market on a global basis and correlates very highly with other small cap value markets on a global basis, doing not better nor worse. And in fact, if you look at the US small cap value market, as best evidenced by the Russell 2000 Value Index, which anybody in India can look up online anytime they want, the correlation over the last 5 years of the two is very, very high. higher than almost anything else. You should think about the Indian market like a small cap value market in a global world, and then think about where that fits in. Typically, small cap value does its very best early in traditional conventional bull markets. This one isn't, because as I said in the video that was presented earlier, this downturn was more in the way it behaved because of the unusual nature of what went on, like a hugely oversized correction rather than bear market, in that the categories that were leading in the bull market before continued to do better in the downturn and have continued to do better since March 23rd in the upturn.
Okay. One of the fascinating things about democracies is that, there's always a lot of noise and expectation and hoo-ha over elections.
Yes.
Okay, so in fact, when I visit some of the finance websites, American ones also, every day I find some article or the other talking about whether, this one will be better, that one will be better for the American economy and these things. Same with the phenomenon here. I mean, the markets, at least that's what the newspapers say, perceive some players to be better than others. What is your take? Should one ignore that completely? Is it just there for the excitement of it all, or is there any substance to it?
There's no substance to it.
Okay.
Just simply, there's no substance to it. And in fact, most people, the reason you read the newspapers is to see what everybody else is talking about, not to see what's true. Okay. Otherwise, newspapers don't really help you get an edge, because the market pre-prices all widely known information, and the newspapers are just conveying widely known opinions. Okay. The fact is, as I talked about in the video, what moves markets relative to politics is surprise. So people think this one's going to be bad. They end up being not quite so bad. Market goes up. They think this one's going to be wonderful. They're never that wonderful. So the market disappoints later, as the surprise is that the person's not so wonderful or the government's not so wonderful. Yeah, ironically, to your point, the news today is fascinating about India. If you were in America and you did a Google search today on India news, which I did before coming in here this morning, it's all about Kamala Harris, because she's got an Indian mother. And you can't, you go way down the list before you find anything other than chatter, chatter, chatter about Kamala Harris. Joe Biden's vice presidential pick as of yesterday, chatter, 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 chatter. Which two markets is all just nonsense.
Okay. Wonderful to have you with us today, and I'm really grateful that you could be with us. Really honored to have you with us.
Well, thank you so much. I appreciate it.
Yeah,
you do a great job, Brown.
Have a great day, Ken. And I hope to stay in touch with you. Okay. Bye-bye.
Bye-bye.